A motel owner from Mississippi made the biggest corporate merger in American history. No finance degree, no telecom background, just a napkin, a coffee shop, and an idea. His company hit $180 billion. His stock rose 7,000%. The press called him untouchable. Then one night in 2002, a quiet woman stayed late at her desk. She was WorldCom's internal auditor. Nobody famous, nobody powerful. And she found $11 billion that had never existed. Bernie Ebbers grew up in Canada, played college basketball, and ended up coaching high school teams in Mississippi. He was not a finance person. He ran a chain of budget motels across the American South. Not the profile you'd expect from one of the most powerful business figures of the 90s. But in 1983, a federal ruling cracked a door wide open. The government broke up AT&T's monopoly on long-distance phone calls. For the first time, anyone could enter the market and sell phone service. Ebbers and a few friends raised $650,000, sat down at a coffee shop in Hattiesburg, Mississippi, and wrote a business plan on a napkin. They called it long-distance discount services. The idea was simple: buy phone minutes wholesale from big carriers and resell them cheaper. Instead of building from the inside, Ebbers kept buying other companies. One acquisition, then 10, then 60. By 1995, he had completed more than 60 deals and renamed the company WorldCom. The stock followed. Through the 1990s, WorldCom shares rose 7,000%. Put $10,000 in at the start of that decade. Get back $700,000 by the end. Wall Street loved it. The media loved him. Telecom cowboy, they called him, the small-town outsider who outplayed every establishment player. Then in 1997, he stunned the financial world. He outbid British Telecom, a 150-year-old institution, to acquire MCI, the second-largest long-distance carrier in the country. $37 billion. At that moment, the biggest corporate merger in history. WorldCom now had 22 million customers, $34 billion in annual revenue, and a $180 billion market cap. Every quarterly report had been approved by Arthur Andersen, one of the most respected accounting firms in the world. Everyone believed them. The numbers said so, and the numbers looked clean. Then 2000 arrived. The dot-com bubble burst. Tech stocks collapsed. WorldCom, a company whose entire empire was built on a rising stock price funding more acquisitions, started bleeding. Ebbers tried one last play, a $54 billion merger with Sprint that would have made WorldCom the undisputed king of American telecom. The Department of Justice said no. European regulators said no. Dead. The stock went into free fall. Here's where it gets dark. While the stock was climbing, Ebbers had been quietly borrowing against his own shares as collateral, personal loans. $366 million. Spent on a cattle ranch in Canada, a lumber company, and a yacht. Now the stock was falling. His lenders were calling. If the price dropped far enough, they'd force him to sell his shares. And when a CEO dumps stock at that scale, every investor on the planet notices. The crash accelerates. He was trapped. His personal survival was tied directly to the stock price, and the only way to hold it up was to show profits that no longer existed. He turned to Chief Financial Officer Scott Sullivan. What they did next was not sophisticated. It was embarrassingly simple. Every month, WorldCom paid billions to other carriers, companies like AT&T and Verizon, to use their phone networks. These are called line costs. Think of them like rent. You record them as an expense, and they immediately reduce your profits. Sullivan started moving them to a different column. Instead of booking line costs as regular operating expenses that hurt profits today, he reclassified them as long-term capital investments. Cost you spread over 10, 15, 20 years, like buying a building instead of paying rent. They disappear from the income statement this quarter. That is the entire fraud. Swap numbers between columns, the expenses vanish, the profits look healthy. The stock holds quarter after quarter from 1999 to early 2002. $11 billion in fabricated earnings. Arthur Andersen signed off every single time. There were red flags visible to anyone paying attention. WorldCom's line costs, the fees paid to other carriers, were falling as a percentage of revenue, even while the entire industry was watching those same costs rise. No competitor showed that trend. Any analyst who compared WorldCom to its peers had the discrepancy right in front of them. The numbers were saying WorldCom operated under different economic rules than every other telecom company on Earth. It didn't. The numbers were just wrong. Then there was the matter of the CEO's personal loans. Public, disclosed. Sitting in the proxy filing that every public company is required to publish, Ebbers had pledged his WorldCom shares as collateral for hundreds of millions in personal debt. A CEO whose financial survival depends on the stock price cannot make honest decisions about reported earnings. That specific conflict of interest was documented and on the public record for years. But the stock was climbing, and when a stock climbs, almost nobody reads the proxy statement. Almost nobody. Cynthia Cooper was WorldCom's vice president of internal audit. She found accounting entries with no documentation, no approvals, no paper trail. Costs moved to capital accounts with no justification. She started asking questions. Scott Sullivan tracked her down, furious. He told her she was wasting her team's time. He told her to back off. According to later accounts, Cooper quietly cleaned personal items out of her desk. She thought she might lose her job. She kept asking, working nights and weekends, deliberately off Sullivan's radar. Cooper and her small team traced every suspicious entry one by one. When they finally sat down with the company's controller, David Myers, he didn't fight back, he confessed. He later told investigators it was the first time he had felt any relief in 2 years. On June 25, 2002, WorldCom announced a $3.8 billion restatement. The stock, already wounded, collapsed to pennies within hours. The number eventually reached $11 billion. 6 days later, bankruptcy. The largest in American history at the time. 20,000 jobs gone overnight. Pension funds erased. Ordinary investors who had trusted the reports, trusted the auditors, and trusted the quarterly numbers lost retirement savings. They would never recover. Bernie Ebbers was convicted in 2005. 25 years in federal prison. Released in 2019 in failing health. He died 6 weeks later, February 2020. Cynthia Cooper was named Time Magazine's Person of the Year for 2002. Not the billionaire, not the deal maker, the auditor who refused to stay quiet. And because of what she found, we now know exactly what to look for. 4 things to carry from this case. 1. Separate acquisition growth from real growth. WorldCom's revenues only increased when it was buying companies. Strip out the deals, and the underlying business was going nowhere. Before investing in any company built on acquisitions, ask this: if they stopped buying other companies tomorrow, would revenue still grow? A company that can't answer yes clearly deserves a harder look. 2. Read the proxy statement. It is the most underrated document in public investing. Ebbers' personal debt situation was disclosed there, in black and white. For years, a CEO whose personal finances depend on the stock price cannot report earnings honestly. That's a conflict of interest severe enough to disqualify an investment, and it was sitting in a publicly available filing the whole time. 3. When a company's costs fall while every competitor's costs are rising, demand a real explanation, not vague efficiency claims, a specific one. Ask how costs are classified. Reclassifying operating expenses as capital investments doesn't make the costs disappear, it just hides them somewhere most people don't look. 4. Auditors are not independent when the company pays them. Arthur Andersen collected millions in fees from WorldCom, the same firm signing off on Enron at the exact same time. An auditor financially dependent on a client has every incentive to avoid difficult questions. Always check who signed the audit report and how long they've held the contract. The fraud here needed no genius, just 2 columns on a spreadsheet and a CFO willing to move numbers between them. The next one will be just as simple. It always is. Every week, a billion-dollar lie moves a little closer to the surface. Subscribe to Capital Sins, not to support a channel, but to make yourself harder to fool, not after the crash, before it. The next investigation is already on screen. Click it.